where prices are right now. On Tuesday, February 23rd, silver futures on the Indian Multi-Commodity Exchange, MCX, rebounded sharply, climbing nearly 5% to around 2.65 lakh rupees per kilogram in futures trading. This surge was mirrored globally. Comex silver futures for the March contract rose about 5.5% to around $86.90 per ounce in international markets. Spot prices have been experiencing heavy swings through the month, hitting multi-month lows, then bouncing back into a strong recovery. In many Indian cities, the price of physical silver sits around 2.74 lakh rupees per kilogram now, after consolidating following last week's rebound. That consolidation tells us that traders are digesting recent gains and losses and repositioning themselves, which means volatility remains high. What's causing these big moves? There are a few major influences at play. They're bigger than simple demand and supply, and they explain why we're seeing such violent swings. One of the biggest drivers right now is renewed geopolitical tensions and global tariff uncertainty. Over the past few weeks, geopolitical risk premium has been rising because of escalating tension between the United States and Iran. We've seen policymakers and markets increasingly view precious metals as safe haven assets when uncertainty spikes. Silver's rally above 5% today came as investors sought shelter from trade disruptions and geopolitical instability. At the same time, global trade policy uncertainty has intensified. A recent U.S. Supreme Court decision overturned broad tariff authority previously used by the Trump administration, but President Trump responded by instituting a new 15% global tariff on imports from all countries. That sudden flip-flop in trade policy has left markets on edge, and silver, like gold, has been a major beneficiary of safe haven demand because of that. In other words, as global trade friction escalates, money is flowing out of risk assets like stocks and into traditional hedges like commodities, especially precious metals. Silver has acted as both an investment hedge and as an industrial commodity, which makes its price behavior more dramatic than gold in many cases. Another key piece of data that traders absolutely need to know about is inventory. Not many people talk about this, but silver inventories on the Comex exchange have fallen to critically low levels. Registered silver stocks have dipped below 90 million ounces and are now shrinking significantly. This reduction is a combination of physical offtake and heavy withdrawals from warehouse stocks. When inventories fall like this, it suggests that physical silver is being taken out of the system, which can tighten supply relative to paper contracts and potentially put upward pressure on prices. Look closely at these inventory trends, because they tell a story you can't see just by watching price alone. Traditionally, Comex inventories serve as a buffer for futures delivery. When inventories are high, it's easier for short sellers and futures traders to find physical silver to back contracts. But now, with inventories below critical thresholds, that buffer is shrinking. Institutional players and traders are watching this very closely. If inventories continue to drop, this could lead to a short squeeze scenario where those who are short silver futures may be forced to cover at higher prices, causing a rapid upward move. Volume indicators and market positioning also show something interesting. ETF flows for silver have spiked as well. Reuters and other market sources reported that exchange-traded funds for gold and silver jumped as much as 17% on the same day's prices rallied. That shows not just futures traders, but also institutional and retail investors are piling back in. But with that renewed buying comes a significant risk. When ETF flows accelerate quickly, it's a sign of heavy sentiment and momentum trading, not necessarily long-term structural demand. Moments like this, especially when driven by headlines rather than fundamentals, can reverse just as fast. Let's talk about the macro backdrop, the dollar and interest rates. The US dollar has been weakening recently due to uncertainty around trade policy and slowing macroeconomic signals. A weaker dollar makes commodities priced in dollars cheaper for foreign buyers. That supports upward price pressure on silver globally. But it's important to remember that silver typically moves more than gold when the dollar weakens. Silver is a higher beta play. That means moves up or down can be more extreme. So if the dollar were to suddenly strengthen again, for instance, if the Federal Reserve signals a shift in policy or economic data surprises to the upside, silver could just as quickly retrace a large portion of its gains. That's where risk comes in, and why right now you do not want to trade silver blind without clear trigger conditions. Speaking of triggers, we need to quantify how volatile silver has been. In parts of early February, silver prices experienced dramatic collapses, dropping from above $120 per ounce to under $65 in one of the largest swings in recent memory. Then, within a short period, silver bounced all the way back toward $80 plus territory. That's hundreds of dollars in swing range, a gambler's dream or a risk manager's nightmare. Now let's talk about what's not being priced into the market yet, but could matter strongly in the next few weeks: physical delivery dynamics on Comex. There are some fringe but serious discussions in commodity circles about the possibility of a delivery squeeze in March contracts. Some market commentators estimate that the ratio of open interest to available physical inventory could create a situation where delivery obligations significantly exceed physical supply. That doesn't necessarily mean a default, but it does mean potential dislocations if participants demand delivery rather than settle in cash. That scenario could rapidly de-anchor prices from their current technical ranges. If delivery demand spikes while inventory stays low, prices could shoot sharply higher in a very short amount of time as longs scramble for physical metal and shorts are forced to cover positions. That's a black swan type of catalyst. Not impossible, and certainly something risk-aware traders are monitoring. Now let's zoom in on something every trader should understand: the recent pattern of price movement this month. Earlier in February, silver hit highs around 3.50 lakh rupees per kilogram in the Indian market, driven by global safe haven rallies. Then heavy selling pushed it down to around 2.55 lakh rupees, a multi-month low. Since then, prices have rebounded back toward 2.75 lakh rupees in a recovery that suggests capitulation at the lows and strong buying interest on dips. This kind of sharp down then sharp up makes silver a nightmare for trend-based systems. Trend traders might get long on the rebound, only to see the market chop sideways or reverse again. So until we see a sustained, confirmed breakout above recent resistance levels, perhaps above the last high near $90 plus per ounce on Comex, it's better to wait for validation rather than trade the noise. So what could happen next? Let's break this down into the most likely scenarios, because if you want to trade silver, you must understand all of them. Scenario 1, continued safe haven strength. If geopolitical tensions continue or escalate, and if global trade uncertainty remains elevated, investors may continue to flock to precious metals. In this scenario, silver could break through key resistance levels and continue higher, potentially retesting levels not seen yet this year. ETF inflows, inventory depletion, and that weak dollar dynamic could all fuel a sustained rise. But rising on fear isn't the same as rising on stable fundamentals. That means many traders might treat upward moves as overextensions, and we could see wild retracements. So it's very different from a clean upward trend. Scenario 2, volatility, rotates into a correction. Let's say news flow stabilizes. Maybe negotiations ease tensions or new data boosts risk appetite elsewhere. In that case, the safe haven bid could weaken, the dollar could strengthen, and silver could retrace a significant portion of recent gains. That means prices might revert to the 50-day average or lower, and volatility could spike on both sides. That's why many professionals suggest using tight risk controls, stop losses, or waiting for clear volume confirmation before initiating trades. Blindly buying in a rising market doesn't protect you when momentum shifts. Finally, there's scenario 3, range consolidation. This is when silver trades sideways for a sustained period within clearly defined support and resistance. This can last weeks or months, while markets wait for macro catalysts like Fed policy decisions, geopolitical news, or economic data releases. In a range market, day trading can work, but position trading, holding for days or weeks, is much riskier unless you see a breakout. All of these possibilities highlight one key truth: silver is not a stable asset right now, and until we see clearer signals, trading it is akin to navigating through a storm without an anchor. Before we wrap up, let me share one more piece of important market insight: the role of industrial demand. Unlike gold, silver has huge industrial use in electronics, solar panels, and green technologies. That means there's real demand beyond investment flows. Some analyses show solar industry demand alone could consume hundreds of millions of ounces annually. That's relevant because as prices move up, industrial buyers seek alternatives or push back on demand, which also influences price behavior, sometimes in unpredictable ways. Let the market confirm a trend first, whether that's a breakout above a critical resistance or a confirmed retracement back into a lower range, before you put real capital on the line.